There is an entire subculture of people who treat credit card rewards like a competitive sport. If you meticulously track points, churn sign-up bonuses, and pay your balance in full every month, the result feels like free money. It feels like you are beating the banking system at its own game. But banks have essentially unlimited research budgets, and they employ teams of psychologists and data scientists for a reason. Credit cards are sophisticated behavioral engineering products. Every feature is specifically optimized to maximize individual spending and eventually the amount of interest you pay. The entire industry is built on a psychological concept called payment decoupling. This is the deliberate separation of the act of consuming from the act of paying. Look at the tension in a cash transaction. When you are physically counting out and handing over physical currency, your brain registers what behavioral economists call payment pain. It is a visceral, negative emotional response that serves as a natural brake on your spending. A plastic card or a digital tap deliberately removes that friction. This chart shows the direct statistical outcome of removing that payment pain. When consumers use credit instead of cash for everyday purchases, groceries, gas, coffee, their spending consistently increases by 12 to 18%. The payment mechanism itself alters their decision-making. The extra purchases easily wipe out the value of a 2% cashback reward. The product is working exactly as engineered, bypassing your natural behavioral limits to artificially inflate consumption. Points, miles, and cashback offers function as calculated behavioral investments designed to dictate exactly how you pay. Every card transaction carries a hidden tax called an interchange fee, typically 1 to 3%. Businesses cannot absorb this loss, so they bake the cost directly into retail prices. Every item gets slightly more expensive to cover the infrastructure of credit. Now watch the economic ripple effect. The cash-paying customer in this checkout line pays the exact same inflated retail price, but receives zero rewards. The Federal Reserve estimates this transfers about $1,400 annually from the average cash-paying household to the average rewards household. The rewards ecosystem quietly redistributes wealth from lower-income cash payers to higher-income points optimizers through a tax embedded in every American retail price. To understand how the debt trap actually functions, we have to look at the 1978 Marquette Supreme Court ruling. This decision allowed banks to export home state interest rates across the country. Overnight, historical usury caps vanished, birthing the deregulated credit card industry. Free from interest rate limits, the industry needed to keep consumers in debt for as long as possible without pushing them into default. They solved this by calculating the minimum monthly payment at a fraction of a percent above the interest charge. Carrying a $5,000 balance while making only minimum payments takes approximately 23 years to clear. Over 2 decades, that balance generates $6,500 in pure interest charges. The minimum payment maximizes the loan's lifespan. The industry pairs this slow repayment with automatic credit limit increases. A higher limit functions as a psychological anchor. A $3,000 debt feels terrifying on a $5,000 limit, but on a $20,000 limit, it feels perfectly manageable, encouraging the user to carry a higher absolute debt load. The monthly billing statement is a meticulously calibrated trap designed to ensure lifelong profitability for the issuing bank. The industry also understands social psychology. A heavy metallic premium card utilizes identity anchoring. It signals wealth and access. By wrapping the debt product in airport lounge perks and concierge services, the card transforms into an aspirational status symbol. Beneath that premium branding is a massive data harvesting operation. Every swipe catalogs the exact time, location, and merchant category. It tracks your dietary habits, your health conditions through pharmacy purchases, and your political activities through donations. Predictive algorithms process this deeply personal transaction data to identify exactly when you are approaching severe financial stress. They use these models to perfectly time balance transfer offers and credit limit increases at the exact moment you are most vulnerable to accepting them. You might want to opt out entirely, but the industry helped build an enforcer, the FICO credit score. The scoring criteria rely heavily on maintaining long-term, active revolving credit accounts. If you choose to avoid debt entirely and pay only with cash or debit, the system labels you as a risk with a thin file. That label creates severe friction when you try to rent an apartment, buy a car, or even secure a cell phone contract. The credit card has become a mandatory surveillance mechanism and a forced toll booth for participating in the American economy. This passbook represents the way Americans used to protect themselves. Before the deregulation of credit in the late 70s, liquid cash savings acted as the primary financial safety net. The personal savings rate hovered between 10 and 15% of disposable income. As credit cards became ubiquitous, the immediate availability of borrowing systematically replaced a savings account. Instead of building a cash buffer for emergencies, households began relying on their credit limit as their default backup plan. A $2,000 car repair paid from a high-yield savings account costs exactly $2,000. That exact same repair put on a credit card bleeds hundreds of dollars in compound interest out of your future paychecks. Substituting debt for savings has left the average household fragile, stripping away true financial resilience at the population level. You do not have to accept the default relationship the industry designed for you. You can intentionally dictate your level of participation. One approach is strategic minimal use. You keep a single card for fraud protection and credit score maintenance. You put a small recurring charge on it, pay it in full automatically every month, keep your utilization below 10%, and use debit or cash for your daily life. Or you can choose a deliberate exit. You aggressively build true cash reserves and dedicated sinking funds. You create enough liquid financial padding that turning to a credit line during a household emergency becomes genuinely unnecessary. The credit card is an extraction tool. It provides utility, but it's built to quietly pull resources away from you. It must be strictly controlled. By understanding the invisible architecture of this behavioral engineering, you can refuse the psychological traps, protect your data, and reclaim the trajectory of your own wealth.